In this video, I will help you understand when not to buy a stock. I will take the example of PFC, Power Finance Corporation. I will also take the example of the weekly time frame chart for this video. Part of this discussion I have already done in my positional stock trading series. I don't think I discussed this particular example, so I wanted to take this example for this video so that you understand when not to buy a stock. So have a look at this. This was marked as base number 2 by Market Smith on its weekly time frame chart. And that base meets the textbook definition of a flat base as per William O'Neill's book. So for example, there are 5 bars inside this base. A flat base as per the book is 5 to 6 weeks long. So it meets that definition. Then the correction inside the base, if you see this, is 15%. So as per the textbook, a flat base does not correct more than 10 to 15%. Look at the volume for the red bars inside the base, low volume, which means institutions are not selling, right? And the price is above the 10-week simple moving average. So it meets all the textbook definition of a flat base. Moreover, at that time, the relative strength of the stock was 94. And since it is base 2, it is an early stage base. Theoretically, not practically, which I will discuss in a while. Theoretically, it's an early stage base because normally a stock would form 5 bases. Market leaders generally tend to form 5 bases. But if you look at stocks like Choice International, go and check the weekly time frame chart of Choice International, you will see 10 bases. And even after base 10, the stock continues to go up. So those are rare cases, exceptions. But generally, stocks form 5 bases. Why I selected this chart to discuss with you is because I want to help you understand when not to buy a stock. So this looks perfect. It meets our textbook definition. It's an early stage, relative strength 94. Everything looks fine. I would still not buy the stock there. The question is why. So let's discuss that. By the way, this is January 2024. It's an old chart. So as per the SEBI regulations, we are allowed to discuss this chart. So have a look at these candles 1, 2, 3, 4, 5, 6, 7. The high of the 7th candle is below the high of the 6th candle. That's a cup with handle, a 7-week cup with handle, which was marked by Market Smith. That's base number 1. So if I have to draw, the high of this handle is 136.08. So 136.08. That's the pivot point of that cup with handle, and the stock broke out of base 1, came down momentarily. It did not come down 8%. It came down like 6 or 7%. Moreover, during that decline, the stock did not close below the blue line, which is the 10-week simple moving average. One negative factor was the stock did close below the pivot point on Friday, which is not a good sign. Okay. But thankfully, maybe the fundamentals of this company were strong or something was going on in the industry, and the stocks in this industry started going up, like Power Finance Corporation, Rural Electrification Corporation, REC, stocks like that. During this period, they went up a lot. Now, after this breakout, what are you supposed to do? If you watched my positional stock trading series, you will understand that after a breakout, we wait for a 20 to 25% move from the pivot point. not from your buying price. We wait for a 20-25% move from that pivot point. After approximately 25% move, we expect a next base formation with minimum 3 weeks of consolidation. However, in this stock, if you see from 136 rupees till about 428 rupees, there is not a single candle or there is not a single bar after which you see 3 weeks of consolidation. How do you determine 3 weeks of consolidation? Well, you need three consecutive candles, and the high of those three candles should be below the high of the previous candle. That is called as 3 weeks of consolidation. And from the breakout that came in May 2023 till December 2023, so roughly 7 months, the stock did not show 3 weeks of consolidation. This is not 3 weeks of consolidation because every time the high of the previous candle would be taken out. So the stock gave a move of 200% before forming base 2. Now you tell me, if a stock goes up 200% and forms base 2, would you call base 2 as a early stage base? No. You have to look at the prior uptrend of the stock before you decide to take a trade on the existing base. So theoretically, what should we expect here? We should expect this to become base 2A, not base 2. Remember, there are three sub bases normally: 2A, 2B, 2C. If the stock breaks out from this base and goes up 20-25%, that would be a base number 2. But if the stock breaks out of that base, goes up like 5-10%, and then falls back to hit your stop loss, that is called base 2A because the base fails. Now you tell me, what are the chances of this base becoming base 2A versus the chances of this base becoming base number 2? Well, I would say since the stock has shot up 200%, there is a good chance that the base will fail. The stock will go up and probably come down to hit the stop loss because a lot of people who bought the stock here might be wanting to book profits there, right? So that's a risky base. The base is not yet mature enough for the stock to make its next move, which means there are still some sellers left. There is still some supply left, which came from the demand that came here. See, the demand here is getting converted to supply here. You understand? So this is more likely to become base number 2A. So the high of this bar is 428.75. 428.75. So let's see what happens. See, it fails. See, after this bar, you have 1, 2, 3. 3 consecutive bars closed below. 3 consecutive bars having their high below the high of this bar. That's a 3-week consolidation. And what's the distance from the pivot point till the high of this? 12%. So the base has failed. So the stock went up 12% and then started falling back, and this probably hit your stop loss of 8%. From here till here, see, 9.76. So the base has failed. So this base has become base 2A. This base, the high of this bar, that's base 2B for 77.80. So let's draw that. You see how easy it is to decode what is the likelihood of a base succeeding, what is the likelihood of a base failing. This was a no-brainer. This was most likely to fail, right? This is advanced knowledge, by the way. This is advanced discussion. If you understand what I am discussing here, you are really going into the zone of professional trading. Okay. So please pay attention. If you are truly understanding what I am saying, please understand that you are on the path of becoming a long term professional positional stock trader. This is a good sign if you are understanding what I'm saying. If you have no clue what I'm explaining here, or if you are not understanding, then you have to go back to the 50-part positional stock trading video series that I created. Spend some time there and then come back to this video. Okay. This is very good information. This is very good knowledge. It has helped me in my trading. It will help you in your trading as well. Okay. Now, base 2B, we know that it's a middle sub base. So normally we expect base 2A, 2B, 2C. So why would I buy 2B? Because the chances are very high that it will buy 2C. It will create 2C, right? So my argument is base number 2C is less risky than base number 2B, because at 2B, the chances of 2C formation is more. So let's see what happens with 2B. Does it succeed or does it fail? Let's see what happens by moving the price forward. See, that green candle has already broken. See, it's gone. This bar has taken out that 8% stop loss. This was the breakout bar. Okay. But base 2C did not form here. Base 2B failed. The stop loss was taken out by this large red bar on high volume. So you understand what I'm saying? Why you should not have bought that base 2A? Because of the prior uptrend. Why you should not have bought base 2B? Because of the likelihood of formation of base 2C. So even though the relative strength is 94, the stock has moved up 200%. The textbook definition of William O'Neill is met here. It is very easy to read a book and apply that knowledge. But when it comes to practical real life experience, I am giving you practical real life experience here. I mean, if you're buying base 2 thinking that it's an early stage base as per William O'Neill's book, you are forgetting to check that previously the stock has shot up 200% from base number 1. That is not early stage, that is extended price action. So be careful. Okay, just because it is base 2 doesn't mean that you buy. Okay, doesn't mean that you take a big position size. And God help those YouTube subscribers who don't even check the base count. I have absolutely no prayer for you. Okay. I hope this video has been helpful. It was very simple video, but very profound if you understood what I am discussing here. If the stock would have gone from here, if it would have gone 25% and then formed a base, I would have taken a bigger position size in the stock. Here, forget about position size. We're not interested in even buying the stock. Even if I buy the stock, I would take a tiny position size with a tight stop loss because the chances of failure are very high. Thank you so much.